December 2008. A quiet penthouse in Manhattan. The city keeps moving as always. Taxis crossing Park Avenue. Financial screens still blinking on Wall Street. But inside that apartment, a conversation is about to detonate one of the greatest financial scandals in history. Bernard Madoff looks at his two sons. For decades, he was an almost untouchable figure, a man who inspired immediate trust, a pioneer of Wall Street. But that night, he is no longer trying to hold the story together. He breathes, and finally says it. It's all just one big lie. 3 decades of wealth, thousands of investors, $65 billion, all of it built on something that never existed. The most respected financial operation in Manhattan was, in reality, the largest Ponzi scheme ever built. And for years, no one wanted to see it. The rise to understand how it happened, you have to go back decades. A young entrepreneur, just 22 years old, founds a small investment firm with $5,000. His name, Bernard L. Madoff Investment Securities. The firm starts as a quiet broker-dealer. Small, conventional, unassuming. But Madoff had one very specific instinct. Technology would transform Wall Street. While most firms still relied on manual processes, he began investing aggressively in electronic trading systems. The bet paid off. Through the 70s and 80s, his firm became one of the leading market makers in U.S. equities. And his reputation grew. He wasn't just profitable. He seemed visionary. Eventually, he rose to one of the most prestigious positions in the industry, chairman of Nasdaq. That title carried enormous weight. On Wall Street, reputation is everything. And Madoff's was impeccable. A technology pioneer, a market innovator, a trusted insider, the kind of person who seemed incapable of fraud. And that reputation would become the foundation of everything that came next. The illusion through the 1990s, as financial markets expanded rapidly, Madoff began offering something that seemed extraordinary. An exclusive investment strategy, not available to just anyone. Many investors had to wait years to be accepted. That detail was crucial, because in finance, exclusivity creates desire. The strategy promised something very specific. Consistent returns. Not explosive, not extravagant. Simply steady, month after month, year after year. Even when markets fell, even when volatility increased, his clients' accounts seemed to advance with an almost mathematical precision. Respected institutions began to invest. Hedge funds, foundations, private banks, charitable organizations, wealthy families, celebrities, universities, all trusting the same man. And that trust was the raw material of the fraud. Because in reality, the investment strategy never existed. Officially, Madoff claimed to use something called split-strike conversion, an options-based strategy. Elegant in theory, plausible to those who didn't dig deeper. The problem is that most of those transactions never happened. No trading records existed. No evidence of the options positions. The supposed transactions didn't appear in the markets. The account statements clients received were fabricated. Every month, every quarter, every year, the numbers were printed in an internal office and sent to thousands of clients who believed they were seeing real results. They weren't. The money from new investors was being used to pay the old ones. That has a name. Ponzi scheme. A Ponzi scheme is a structure of false payments. Returns don't come from real investments. They come from the money of new participants. The more people invest, the more the system appears to work, but it always needs more new money than the last. And when that flow stops, everything collapses. The man who saw IT for more than 20 years, the fraud worked. But someone did ask the right questions. Harry Markopolos, financial analyst, meticulous, technical, uncomfortable. In 1999, Markopolos began analyzing the returns reported by Madoff. Something didn't add up. The results were too consistent. Even the most sophisticated strategies show variability, noise, errors, occasional losses. But Madoff's accounts seemed to advance in a straight line. No variation, no stumbles, no possible statistical logic. To Markopolos, that wasn't a sign of genius. It was a sign of manipulation. His analysis reached a decisive conclusion. The reported strategy could not generate those results. There simply wasn't enough volume in the options market to support the trades Madoff claimed to be executing. It was a statistical impossibility. So he did something unusual. He alerted the authorities. He filed detailed reports with the SEC. Not once, multiple times, over years, with calculations, models, technical evidence. But the warnings produced no meaningful response. Investigations were superficial. Regulators failed to grasp the arguments. And Madoff's reputation acted as a shield. Because accusing a figure that established meant accepting something deeply uncomfortable. That Wall Street had been deceived for decades. And no one wanted to be the first to admit it. So the warnings were filed away. And the scheme continued. The collapse in 2008, the global financial system began to fracture. The mortgage crisis was spreading through the markets. Financial institutions were collapsing. Funds were losing value. Investors needed cash. And that meant withdrawing money, including money from Madoff's fund. Suddenly, thousands of clients requested their capital back at the same time. Billions of dollars. But the money wasn't there. It had never been there. For decades, the system had worked because inflows exceeded outflows. Now the opposite was happening. Withdrawal requests far exceeded the money available. The scheme had reached its mathematical limit. It could not continue, and Madoff knew it. So that December night, he called his sons. He explained the situation. His sons didn't react as accomplices. They reacted as citizens. Hours later, they contacted the authorities. The next day, federal agents arrived at the apartment. When asked if there was any explanation for what had happened, he answered with a phrase that would become historic. Basically, it's a giant Ponzi scheme. He was arrested on December 11, 2008. Estimated losses, approximately $65 billion. The largest individual financial fraud in modern history. Victims were everywhere. Pension funds, universities, charitable foundations, entire families. Some organizations lost virtually all of their assets. In March 2009, Madoff pleaded guilty to 11 federal charges: securities fraud, money laundering, perjury. In June 2009, the sentence arrived: 150 years in prison, the maximum possible. But even that number could not repair the damage. The system, because Madoff's fraud, raised an uncomfortable question. How could it happen for so long? The answer is disturbing. It was not an extraordinarily sophisticated fraud. It used no complex algorithms, no incomprehensible financial structures. It was, in essence, a classic Ponzi scheme, a structure known for more than a century. So, why did no one stop it sooner? Because the system had incentives not to question it. Investors saw consistent returns. Intermediaries earned commissions. Institutions enjoyed exclusive access. While the money kept coming in, no one wanted to break the illusion. Questioning the fund meant risking gains. And admitting that something too good to be true probably was. So most people chose not to look too closely. That was the real engine of the fraud. Not complexity, complacency. The fraud worked because too many people assumed someone else was verifying the numbers. Investors assumed regulators were checking. Regulators assumed investors were asking questions. Intermediaries assumed reputation was guarantee enough. But no one was. The collective illusion was too convenient. Today, the Bernard Madoff case remains one of the most disturbing stories in financial history. Not because of the money lost, although $65 billion is an extraordinary figure, but because of how simple the mechanism was. The same type of fraud described by Charles Ponzi in 1920. A century later, the most sophisticated financial system on the planet fell into the same trap. Because the fraud didn't work through complexity. It worked through trust and the absence of skepticism. Because when money seems easy, the hard questions disappear. And when the questions disappear, the truth can hide for decades. Until, finally, someone is forced to say it out loud. It's all just one big lie.